So we have an atmosphere of skepticism in the tech market. The Wall Street Journal, for example, noting that CoreWeave, which has plenty of debt, has seen its stock declining rapidly over the past week, still well up from its IPO. That is a computer equipment and services darling. Let's get more on this malaise in tech stocks, lots of them off their highs, including Meta. We're joined by Sam Labell, portfolio manager at Veritas Asset Management. Sam, great to see you. Maybe you could put up a one-year chart for the NASDAQ 100 as a proxy for the big techs. What do you think? Have they hit a wall here, or is it just a blip? I know that's essentially an impossible question to answer.
Well, one of the things that's going on is we're living through a very unusual period here. We've had a government shutdown, taken away all of the economic data that we usually rely on. Retail sales, GDP, all of these things will be delayed. So with that uncertainty, it's hard to tell what's actually going on in the underlying economy. It's hard to tell whether we're having a normal slowdown, whether we're having the after effects of the government shutdown. A lot of economists believe that government shutdown, because it took away people's paychecks, it took away the paychecks of the direct employees and the contractors. They think that's going to shave 1 to 2% off the annualized GDP number for Q4. So the market is rightly thinking, well, if GDP slows, what about all these high valuations for tech companies? Are the income flows into equities going to slow? Because if people aren't getting their paychecks, they're not paying their 401k contributions, there's a slowdown of inflows into the equity markets. And so when we think about these tech valuations, I believe, and they require new blood all the time. In other words, they've got to have people moving money into the market to continue to bid up the price of the valuations. And so to the extent that that will slow or the economy starts to falter a little bit, there is a correction that can happen. Obviously, everyone who looks at these metrics has to have a view both on the growth rate of the tech earnings, the growth rate of investment into AI, the growth rate of chip spending. All of these things go into the compress, so to speak, to decide what are we going to pay for these valuations. But if fundamentally there's no cash moving into the markets, or if cash is sort of retreating from the markets, then it's really hard to sustain things that are mostly based on hopes and dreams about where we'll be in 10 years in the tech world. So we are cautious on the AI space. We think that there will actually be a fair amount of weakness coming in Q4. We have no data to go on, but we will get some really key bellwether earnings this week out of the big retailers in the States. For example, Walmart, Target, Home Depot, Lowe's, TJX, all of these retailers with October 31st quarter end. So that October 31st date will have at least a month worth of the slowdown from the government shutdown in the US. And again, that's stretched into Q4. So we're expecting weak retail numbers expressed by the earnings of those companies, and potentially a reduction in guidance going into Q4. And the biggest challenge is that you won't be able to tell whether that's just government shutdown or there's a greater malaise kind of settling in on the consumer due to tariffs, due to all of the different factors that are at play. And for that reason, the uncertainty really isn't good for markets. So here you might be dialing back risk just on the lack of data and the lack of confidence in what might happen in the next couple of months.
You have some stock ideas for us, and it's interesting. People sometimes say, well, just buy the Brookfields, because generally they've had pretty good returns over the years. But you're avoiding the biggies, Brookfield Asset Management and Brookfield Corp right now. But you do like the look of Brookfield Infrastructure. Start off with why you're, before we talk about Brookfield Infrastructure, tell us why you're cautious on BAM and BN, please.
So really the model for BAM, for Brookfield Asset Management, BAM, and Brookfield Corporation, BN, the model is to get capital, make great investments that exceed the cost of that capital, and return in a leveraged way the returns to shareholders. The challenge is when the market slows or the capital markets slow down, that capital slows down, the cost of the capital goes up a little bit, and we're seeing, for example, credit spreads are narrowing. So that's a big factor when you're considering what kind of returns you can get off your investments. We're seeing peers in the US of those of BAM and BN. They've been squeezed quite a bit harder on valuation, and it's kind of a catch up that we would expect BAM and BN to experience here to the US peers. So we're avoiding that for now. There have been some bubbling up of private credit issues. We're not seeing any of that specifically at BAM or BN yet, but with those concerns, kind of the discount rate goes up. So we kind of avoiding those names just on the fact that they have a premium valuation that can get hurt in a retreat on valuation. We do like Brookfield Infrastructure. You're getting double-digit FFO with the funds from operations. That looks like it's going to grow double digits. They've done a really good job of investing and recycling some of their projects. So they buy, invest, and then sell at a premium some of their assets. They're starting to gain interest on the utilities interest because AI will require a lot of new utilities investment, and they're well positioned to do that. So we like that as an option, and it's a good yielding play.
You have another couple of stock ideas for us. Bombardier, they're seen now as a potential defense play. They could well get some of the money we're going to be spending on weapons. Yeah,
we've seen some interesting talks happening over Swedish fighter jets, and maybe there'll be a mix there. I mean, when the government makes decisions on defense spending, they do look for what kind of industrial benefits it can create for Canada. And, buying F-35s doesn't necessarily do a lot for our industrial complex, but we could potentially mix in some of these other fighter jets. We would expect that Bombardier would be an excellent bidder in some of that contract work. So there is some interest increasing there, but fundamentally their order backlog is very strong and they're growing in the aftermarket business. So there's still some room here for the multiple to expand a bit. And the cash flows have been improving for the last couple of years. So we like the name.
And finally, we're tight for time, but CP Kansas City, people were worried that tariffs would disrupt cross-border trade. We saw weakness in those stocks, but you like this rail carrier.
Yeah, ultimately, you're still going to get low double-digit EPS growth next year. The multiple has retreated back towards peers, so you're not paying a huge premium for CP. And our bottom line expectation here is that there's not going to be a crash in the economy in 26. We think the real economy will likely hold up, even with some of the tariffs slowing a bit of activity. The consumer in the U.S. effectively is paying a tax on some of their consumption through the tariff, but we don't expect that the consumption is going to collapse. And with interest rates coming down, there's a number of interesting sector plays that could happen if interest rates and long-term mortgages in the U.S. come down. The home building industry picks back up. There's increased spending. So there's a lot of benefits here that could happen just from a weaker economy combined with lower interest rates that can help a stock like CP.
Thank you very much, Sam. It's great talking to you as ever.
Thank you.
Sam Labell, Portfolio Manager at Veritas Asset Management.